All right, let's talk about something that's caught the attention of millions of Americans. The promised $2,000 tariff dividend, first introduced on November 9, 2025, a payout that many people think could drop into their accounts any moment now. But here's the real question everyone is whispering. Is that actually possible? Can the money generated from tariffs alone support a nationwide payment? And more importantly, what does this promise really mean for you? As an investor, as a shopper, and as someone trying to protect your wallet in an unpredictable economy? Because the headlines say one thing, social media says something completely different, and the actual numbers, the real math, tell a story of their own. So in this video, we're going to slow things down, take a breath, and break this entire promise apart, piece by piece. We'll look at how tariff money really moves, how the numbers line up, what the true cost of this payout would be, and the ripple effects every smart investor should be aware of, with no politics, no bias, just clear information and grounded calculations. And trust me, once you see who pays for tariffs, where the revenue comes from, and how it affects everyday essentials, you'll understand why analysts are calling this one of the most misunderstood economic promises in years. So stay with me, because what you're about to hear could change the way you save, the way you invest, and the way you prepare for the next year. Let's start with the foundation. The entire idea behind this $2,000 tariff dividend comes from one assumption: that tariff income flowing into the U.S. is big enough to fund these payments. And on the surface, it sounds simple. Raise tariffs, collect more money, send out a dividend. But once you look closely, everything becomes much more complex. Here's the truth most people don't realize. Tariffs aren't paid by foreign governments. They're paid by U.S. importers, American companies. When a product arrives at a U.S. port, the business bringing it in is legally responsible for paying the tariff up front. And no major retailer, not Walmart, not Target, not Nike, not Home Depot, is going to quietly absorb those costs. They have margins to protect, shareholders to answer to, and quarterly earnings to maintain. So what do? They push that cost forward, straight to the consumer. And we're already seeing the impact. Prices on everyday items, bananas, coffee, electronics, clothing, home goods, have climbed far faster than the official inflation rate. Inflation might be reported around 3%, but certain essentials have jumped much higher. Coffee has surged noticeably, bananas cost more than last year, and imported categories across the board are rising. So yes, tariffs bring in revenue, but they also raise prices at the same time, because the cost lands on American shoppers, not foreign exporters. Now let's take a look at the actual numbers behind the promise. Tariff revenue for 2025 is projected to end just under $300 billion. That's huge, much higher than previous years. And that's exactly why the idea of a dividend sounded believable to so many people. But here's the financial reality. A nationwide $2,000 payment would cost around $600 billion, based on what similar federal programs have cost in the past. That means the required amount is almost double the current tariff revenue. So there's a real undeniable mismatch between what's coming in and what would be needed to deliver the payout fully. And for investors, that mismatch matters. Anytime projected spending rises far beyond incoming revenue, it opens the door to important questions. Not political questions, but financial ones. Questions about funding sources, future borrowing, inflation pressure, policy adjustments, and how quickly markets will react if expectations shift. This isn't about supporting or criticizing the government. It's simply about understanding the math. And when the math doesn't line up with the promise, smart investors start paying attention. Because big economic promises, even well-intentioned ones, always come with side effects. On prices, on spending behavior, on business decisions, and eventually on the larger financial landscape. And that brings us to how this affects real life, long before any payout even happens. Right now, 3 major shifts are already unfolding. First, everyday prices are rising immediately. Tariffs don't wait for approval or for dividends to be distributed. The price impact is instant. Retailers adjust the moment their costs increase, and shoppers feel it right away in grocery aisles, electronics stores, clothing racks, auto parts, and home improvement sections. Families notice it long before they ever see a benefit, which raises a serious question. Will a potential dividend be enough to offset the long-term rise in prices? Second, spending habits across America are already changing. When goods become more expensive, people adjust. They cut back on certain purchases, move toward cheaper alternatives, delay big buys, or shift priorities. And the moment consumers change their behavior, businesses feel it. Some categories slow down, some retailers see traffic drop, and some companies raise prices again to protect their margins. This movement shows up directly in earnings reports and stock market performance, something every investor watches closely. And third, the Federal Reserve is watching all of this very carefully, because any increase in prices, even a small one, affects how the Fed looks at interest rates. If inflation pressures build, it could influence decisions on borrowing costs, lending standards, mortgages, credit, savings rates, and overall economic momentum. The ripple effect moves through the system much faster than most people realize. So here's the bottom line, and it matters. The promised $2,000 tariff dividend is a bold idea, and it grabbed national attention immediately. But before anyone counts on receiving it, they need to understand the full financial chain behind it. Tariffs generate revenue. That revenue comes from American importers. Those costs get passed to consumers. Prices rise, spending patterns shift, markets respond, and the Federal Reserve adjusts its entire strategy based on how the economy reacts. So yes, a dividend may be possible in the future, but the numbers, the timing, and the broader economic effects matter far more than any headline. As an investor, your real advantage isn't predicting the payout date, it's understanding how the system reacts before the payout ever arrives, because that's where real opportunities and real risks show up first. Stay informed, stay flexible, and above all, watch the numbers, not the noise.